All right, Ryan, happy Friday, sir. How are you?
I am good. Facebook Friday made it through. Well, halfway
Yeah.
through.
Another week. And now we're, what, 2 weeks into lockdown round two?
Yeah, that's kind of what they're saying, right? That we're locked down here for a little bit, round two. And then you
Yep.
read somewhere and somebody says, no, it's only the first phase. We haven't even hit round two yet, but who knows? I've lost track of what's open, what's not, what you can and can't do, how
Yeah.
to handshake somebody, or do you elbow them or fist bump them or just give them a head nod? I don't know.
Yeah.
It's
Yep. It's different every day. So we'll
yeah,
just wing it.
got
Um,
social atrophy.
no kidding. So I guess a good place to start today would be forbearances. I know a few things have changed there. And so I'll let you talk on that and I'll talk about the notices of default and what's going on with that.
Sure. So forbearance, now we're in July. And when this all first kind of hit, and it was kind of the big deal on the news, and they're coming out on the news channels going, hey, just call up your lender and say, skip my payment. I've been affected directly or indirectly, through COVID-19. I'm going to skip my payments. So a lot of those payments were April, May, and June. They were given an automatic 3-month forbearance on their mortgage for a quick either phone call and sometimes even the press of a button.
Yep.
It was super easy. Well, we're in July now. So that if somebody did this in the early stages, they went April, May, and June without making that payment.
Yep.
Guess what comes in July?
The fourth
4 months worth of mortgage payments because you owe April, you owe May, you owe June, and guess what? You still owe July. So now our industry is in a very, very interesting position to where they have to say, did somebody maybe get this? Maybe they didn't really need it and they've been stacking away that extra cash as an emergency fund. So they do have the 4 months payments and they're going to get themselves current. Or maybe they got back to work and they got the money kind of saved up, or they don't. They haven't been back to work because there are some people that are still not back to work. So this is a very, very interesting time that we should all be paying attention to and to seeing what happens. And we're getting early signs of what banks are doing, what clients are experiencing. So I've heard from some notaries that they're notarizing loan modifications for a lot of families that were in a forbearance. Now they're doing these, they're meeting with them, send out a small, like slim set of loan docs, and they're doing a modification, not for the interest rate or term, just for the missed payments. They're trying to put it on the back end of the loan. That's not every case. And I think a lot of people thought automatically it was going to be on the back of the loan. I just make a call and it goes in the back of the loan.
Yeah.
It's not that way, not automatically at least. It could be an option. It doesn't always happen that way. One of the other things that we're noticing is on the pre-approval side. I had a client recently that had pre-approved in the month of May.
Yep.
Okay. We looked at everything checks out. This guy's going to relocate from another state. Gets to a point where he wants to write an offer on something, and we're taking a look at some updated documents and realize that he has not made a payment since April. Well, the loan type that he's looking for says you have to have 12-month clean payment history.
Yep.
We don't have that because he skipped April, skipped May, skipped June. So in that specific scenario, we had to readjust how we're going to approve this guy who is now trying to sell a property in another state, relocate here to California, and doesn't actually qualify because he hadn't made those payments, and to no fault really of his own. I think he felt like he made a huge mistake, and he didn't. It was just that was what he was kind of told, or he called up and they made it super easy on him. So he didn't know anything was going to be any different. So kind of the rule of thumb is if somebody is in a position, and by the way, like this particular guy did not have to, he didn't lose his job. He just thought, why not? So in his specific scenario, another phone call maybe to a realtor that he may trust or be local, or to a lender to get a second opinion on it would have been a great idea, because we could have told him, there could be some impact on the, what he's trying to do down the road. Mm-hmm. For a family that maybe had to do this, either go later or opt in for forbearance, you got to do what you got to do. And there are ways to get around that on a future purchase. But so we're just now starting to kind of scratch that surface on what that looks like for somebody who may be buying in the future, or maybe be in a position to refinance as they come out of this.
Yeah.
So kind of interesting times.
So with that, it's no longer, they're on forbearances, and that client that had missed the payment, we're not looking at 12-month history anymore on that, right? They're doing 3-month histories.
Depends on the loan. So a conventional loan, a loan that would be backed by Fannie Mae or Freddie Mac, they basically came out and said, okay, we realize this is going to be a big deal. They say, look, if you took the forbearance, but you made your payments the whole way. So some people could opt into forbearance, or their lender might have already opted them. There were some lenders or some servicers that just put everybody on their whole book in forbearance.
Yeah.
Because they had too many phone calls. So if you kept making your payment, it's like nothing ever happened, right? So for a new loan, new refinance, new purchase, no big deal, easy. If you missed payments, all that they say, again, in a conventional environment, so a Fannie Mae or Freddie Mac backed loan, if you brought those payments current, so let's say you didn't make April, you didn't make May, you didn't make June, but in July, you got current. You paid 4 months worth of payments, July included, and you got current. You're good. If you went into a modification period on these same kind of programs, you're good with some additional pays. And a lot of those are about 3 months worth of, making sure on that new trial payment plan, or you got caught back up. If it's a government loan, an FHA or a VA loan, and you're in a forbearance and you miss payments, that's where you're going to get hit hard, because that needs a 12-month payment plan or payment history that's clean. And if you've missed some of those, you've interrupted that 12 months, the guidelines as of today are basically saying you're out of luck. You gotta try a different kind of program.
Okay. That's fun. So on the loan mods, I know you haven't been seeing them, but with the notaries, has anything been mentioned about any kind of like a prepayment penalty, or like with short sales, or the old loan mods, they would say, if you sold the house within 3 to 5 years, that you would owe X amount, of the principal reduction or what have you. Have we seen anything like that yet?
I think they're all going to, so a loan mod is really going to be case by case based off of somebody's specific situation. It's not like an automatic, they tack it onto the back of the loan or they just forgive it. Every scenario is a little bit different when it's a loan modification. There's a whole review process around that to kind of figure out and gauge the risk, and when is this somebody that needs a temporary fix or a long-term solution. Mm-hmm. From what I've seen these, some of these that missed payments. So let's say that you had, $7,000 worth of missed mortgage payments. They're going to tack that onto the back end of that loan. And it's not forgiven. You're going to pay interest on that too. You're just not having to bring it all current today. So if you were to sell the house, let's say in 6 months, then you would just have a payoff that has that extra money attached to it. So it doesn't go away. It's just deferred.
Yeah. And and these are all short term, so it shouldn't really be a big deal. I just remember, there being even a few years ago, that when we sold the house, that people had done a loan mod, in 2010 and 11, and totally forgot about it. And then we had these surprise payoffs pop up for the principal reductions of like 60 grand. And years ago, that was creating problems, but not so much now.
Right.
Okay, so that's good. And again, this is the first month of possible problems to rear their head. Last week, I was talking about the number of notices of default. It was super low. It was like 200 for the year, and like 100 of them were in January. And I just looked this morning. There's only been one notice of default filed in July. I know that the moratoriums got extended through September, which is interesting. I was talking to an attorney about an eviction the other day, and he said that the moratoriums are extended through September, but they don't expect to be able to do anything until January. And that's going to be fun.
Yeah, you're going to see even some longer moratoriums on some of that in highly impacted, high rent areas. Like do a search for San Francisco, for example, and there's rumor of 3-year moratoriums on evictions that are currently being discussed right now. So now imagine the impact to an area like that, so if somebody had a position where they couldn't make their rent and they got approved for this, so they can't go after them. They can't kick them out. Now the landlord at that point could personally go after them in small claims court, but would not be able to evict them. So you're in a weird dilemma. You have a house here or apartment or condo or whatever that you can't receive any income off of. Mm-hmm. So then your income, your business is impacted as a landlord.
Yeah.
And you can't get them out of there anytime soon. You can go after them through small claims and try to collect your money there. But if they're insolvent, like, what is that going to do? So,
Yeah.
And we're not talking about cheap rents in markets like that either. I think the markets that are going to be most impacted, the rents are fairly high. So
Yeah.
very interesting in that regard to see what happens there. You know, my opinion on, like to your point about notice of default, like there's one, and there was only 200, and most of those were done in January.
Mm-hmm.
There's a misconception now that we've got this, we're knee deep in COVID and we've got this unemployment and all this stuff, and there's a ton of foreclosures. And it's just not the case. And if that were going to be the case, it's so far down the road because all of the backstops that are in place before that have to be broken through before you get to that spot where these come out on the market and become available to purchase. So it's not next month. It's not this time next year either that you're going to be able to pick up these crazy cheap deals on houses. I mean, it's you're talking years down the road before this happens. And they're currently talking like through Fannie Mae and Freddie Mac about mandating, just standardizing after a forbearance, standardizing what that's going to look like. So forbearance and then automatic, everybody follows the same rule book for a loan modification. And so they're talking about that with in efforts to make sure that some of these highly impacted areas or households don't go into foreclosure. It's actually the last thing that they want to happen because they realize what happened last time is just drastically annihilated. You know, the housing sector of the GDP is very, very high. So we lose foreclosures. You don't have building going on. You don't have, you know, there's a lot. You can start to really figure out like all these different areas that are touched by one single home.
Yeah.
They don't want that to happen. So,
yeah. You remember people like Washington Mutual and Countrywide that don't exist anymore? Yeah.
Yeah, exactly.
Massive impact.
And the other interesting thing to think about and to really watch for all of us, myself included, we don't know where this is all headed, is we have an election year. Depending on what happens there, right? Status quo or a change, that's going to have a heavy impact on what decisions are made on these things, because these aren't going to be final and set in stone and in place. They may do a push to get that done before the elections. But if it's something that's trying to pass in the middle of that election, and then there's a change of hands, or who knows what, it's going to be interesting to see how that kind of picks up and moves forward from there. So
so that's awesome that you said that they're trying to standardize the loan modification process after forbearance, or I guess the after forbearance process, which should look like loan modification. That makes me think that they actually learned their lesson from last time. Like we just said, like last time it was devastating. And when this all first happened, it was like for sure week one, but it felt like day one of lockdown when the president came out and he was like, okay, the banks are going to issue forbearances. And that took me by surprise in a couple of ways. Like the first way I was like, okay, that was really, really fast. Like maybe this is going to be far more extreme than we thought it was going to be. But then I got a little bit grumpy because I was like, man, if they could do that, day one or week one of this, and they didn't do it last time, man, I mean, imagine if they had standardized that, if they came out and said, okay, everybody that's adjustable rate mortgage, hey, banks, I'm sorry, but you're going to have to go ahead and, freeze the interest rates where they're at for the people with existing mortgages. It would look way different right now if 2008, didn't happen. So it's awesome that they seem to have learned their lesson and that they're going to standardize the after process. And I mean, I'm curious to see how that looks. I'm happy to see that. No one wants to see the Valley have a 90% turnover rate again with foreclosures. That was rough, man.
I mean, those were, a lot of us were, doing what we do now in that environment. And I remember having conversations with people that you just can't help. And that's when the business got really draining, hearing somebody that's pleading for you to try to help them even save a few $100s a month that would really make a big difference on their monthly or allow them to stay in that house, and you can't do it because they were late or whatever the situation was. So Yeah, I think just in the sense of like the banking doing forecasting and saying how bad could this get? I mean, those conversations and those models actually exist, and saying, all right, great, let's get out in front of that and let's curb the issue. Let's flatten the curve, so to speak,
Yeah.
in the damage that can happen to the economic landscape. And let's focus in on housing for one. And there's other sectors that they've got a lot of attention on as well.
Mhm.
But housing's a big deal. So yeah, it's encouraging to see that they get out ahead of that.
Yeah.
Be interesting to see how that kind of unfolds over time. But
Mhm.
yeah, it could potentially be a lot like right now you could have record defaults, and we have one of the lowest default. If you look at loans, they're in almost the lowest default center ever.
Yeah.
And I think on a forbearance level, last I checked, was like 8.6% of all loans are in forbearance. Now, that doesn't mean they're not making their payment. It just means that loans have a tag on them that says they're in forbearance. And again,
Yeah.
people could be in forbearance and still make a payment, or they auto enrolled in it from either the button push they didn't mean to hit and it stuck them in there, or they didn't actually need it, so they kept making payments, or the bank decided that they're going to put their whole portfolio in. That stuff actually happens. So, but again, that's 8.6%. It's high,
It's
but
not
we
bad,
look
though.
at, yeah, it's not as bad as it could have been. I mean, you could easily have 50% or something. I mean, you could have some massive amount of people not making payment without any kind of government backstop. Then all these servicers are wiped out. You've got a gigantic disaster. So they did a good job getting out in front of that. The other thing I was going to say is, as it relates to unemployment, if you look at some of the numbers on unemployment, we put a lot of jobs back into the workforce. On the last unemployment reports, something like 5 million jobs. So unemployment came back, and it's come down. I think it's like 16%, somewhere around there. Unemployment is still high, but it's a huge, like a really, really rapid turnaround from some of those numbers we were seeing in the early phases.
Yeah, so that's good. And with that, I mean, the demand in the market hasn't changed. I mean, if anything, the demand just keeps getting stronger and stronger. I looked earlier, and the number of homes we currently have for sale from Roseman to Acton, 290. That's all price ranges.
Right.
And then I looked, and I was like, okay, how many pool homes are there? Because obviously, it's getting hot, and that's a hot button right now. So pool homes for sale from Roseman to Acton, 51. And a lot of those are condos, actually, because I just did any property that.
Oh, so if they list pool and the amenity, it came in the report.
Yeah. So probably 10 of those are condos. So we've got 40 pool houses for sale.
That's
any price range.
Crazy.
It is crazy. And with the inventory level being so low, so we've probably had on 3 or 4 properties in the last week and a half, we've had offers come in sight unseen, and like even one yesterday, the guy's hoping to see it tomorrow, but they wrote it 10 grand over asking without seeing it. Yeah. And they're good, and it's just so interesting. And then another property we had 9 offers on it in the first like 48 hours. It was so obnoxious. I mean, anyway, the demand is there for sure. And the demand is from all different pools of buyers. I mean, we've got, on that one, I was super surprised to see that we had people coming in to buy it as an investment property.
Right.
I mean,
you'll have, low money down or low money down, like first time buyer stuff. You'll have people trying to use an assistance program. You'll have somebody doing 30% down as an investment.
Yeah.
And everything in between in that same mix.
Yeah. And so, but like we were talking about with, Frisco and the moratoriums being 3 years, that's absurd. Right. But, it is and it isn't. But with things going that way, and right now, if we're saying that you can't evict anybody till January, right? I'm not looking to buy an investment property right now. Like I would let, the dust settle before I did anything like that. I don't know. It just seems crazy.
So that's interesting that you mentioned that, because so if you say, look, I don't think I would be the one doing that, just because I could potentially throw a tenant into the property and they just don't pay from day one.
Yeah.
Because that's the environment. So the banks recognize that as well. So when we're looking at loans, loan options and opportunity, investment properties are still priced with a lot of risk. So they're higher. They've always been higher, but they're higher in only in interest rate, but also in points.
Yeah.
And they're really looking for somebody who's very well qualified, very strong to be able to take advantage of those. We've seen, where banks at one point, they would allow you to have 10 finance properties. And some of them come back and they said, no, we're going to go back to old rules, like no more than 4.
Yeah.
That's it. Yeah. And that includes the one you're trying to buy. And some of that just has to do with that exact point. Like they realize that not just in Lancaster, Palmdale, but all over the place, that some of these moratoriums are either in process or maybe extended, and they want to make sure that the landlord has enough capacity to carry that loan or to carry the mortgage without the help of a tenant who may or may not pay.
Yep.
That's a very real thing.
Man, bringing it down to 4, that's crazy talk. I haven't seen that number in a long time. I remember, 10 was a big deal, but I remember back before the market crash when they reduced it, I think it was to 20 or maybe 15.
Yeah, they were like unlimited at some point. Like some of the portfolio banks were like, I don't care.
Yeah.
As long as you got enough money in the bank, we're good. You can have 100 finance properties, no big deal. Those guys are gone. And then the ones that had shrunk down and kind of fit, the Fannie Mae approach, which was 10, they rolled back to 4, kind of old rules. And again, some of that will loosen a little bit down the road as we get more details about, where some of the ending is on moratoriums. And they can start to see the data that, these houses are getting paid. They're not, going into foreclosures, not in default, not running lates.
Yeah.
You'll see the banks come back and have an appetite for it. But right now they're nervous for sure.
As well they should be. I mean, the climate right now is crazy, but so I remember back then, when they reduced it down to 20, I remember a lot of people making the play of, either paying off or selling their single family residences and rolling that money, if they exchanged it or whatever, into, commercial, like apartment style, like 5-unit or more buildings. And they would just keep rolling those into, the multi-unit, because they could only have 10 single family mortgages.
Right.
Are there any guidelines? Like, have you seen any restrictions on that right now? Or is that still a good
yeah,
play?
commercial, really the 5-unit, once you get to 5 units and more, it's commercial.
Yeah.
That space is a totally different animal. And it's all about rent roll. It wants to make sure the property is going to cash flow and that kind of thing. And there hasn't been as much. I don't dabble in that quite as often, but from what I have seen, it hasn't been affected as much. I can tell you that they're pricing for risk in terms of interest rates. So where we have in residential, we have these amazing record lows. On the commercial side, depending on what you're trying to borrow and what your loan to value is and how much you're leveraging, you may be in for a little bit of a surprise and see those rates that are offered are even higher than what you expected.
Yeah.
Because they're a little bit concerned about that, or the down payment requirement starts to increase a little bit too. And the reason for that is they're trying to make sure that they've increased the debt servicing that they're looking for. So in other words, what's the cost to carry that loan? What's the mortgage, the property taxes, everything? How much rent's coming in? You're going to debt service that. You want to make sure you have enough. So they've increased, how much more rent or how much more profitability you need to be able to carry that specific debt. So I've seen a lot of banks, kind of shift that way too. And some are completely out of the game. Like they don't want to touch anything under like, $1 million, and everything below that, it's not worth their time. They're not interested. For a while there, actually, I was looking at some commercial stuff, 5+ in the Antelope Valley. And I would talk to some of these banks, they're out of Newport Beach or Irvine or something, and looked like they had a good option. And you reach out to them and they go, oh yeah, we don't lend in the Antelope Valley. Like, why?
Yeah.
It's just not worth our time. Like, we're good.
I remember hearing that a few times. That was interesting, but it is what it is. Do you know if they differentiate between property types on the commercial loans, like retail versus, multifamily?
Yeah, I mean, what they offer, so retail, shopping center, commercial condos, for example, commercial space, office building, that's all going to have different guide sets.
I would think that the retail stuff would be extremely high risk right now.
Yeah, so retail, I haven't, again, I don't do a lot of that, but I have heard, people that are looking to open up, a boutique and trying to get a small business loan. I mean, they're just getting told no everywhere. They're like, are you crazy? You're gonna open up a retail, you can't even like physically open the doors right now? No, you're good. Keep running out of your garage.
Yep.
Yeah, I just can't imagine that there'd be a huge appetite for the banks to get excited about that right now. So I think that's definitely been impacted.
For sure. How are not loan mods, refinances going right now? Are you guys
Good.
seeing an uptick in that?
Yeah, the refis are crazy. So from a rate standpoint,
Mhm.
and we just keep finding new bottoms. It's like we go back, so many calls ago, oh, record low, and then it's like the next week, oh, it's a new record low, and then this week, oh, new record low. We
Yeah.
keep finding these new record lows, and like where that bottom starts, I don't know. I mean, we can just kind of watch the projections, watch the trading. So we use the 10-year treasury or the mortgage-backed securities. We'll look at different things there. And part of the indicator on where things are trending is also the government or the Fed's ability to purchase mortgage-backed securities. So they'll invest in these various spaces. And they have different coupons. So they have like a 2% or 2.5% or 3% coupon. Doesn't mean that that's for 2.5% rates or 2% rates, but it has a general trending. And so we're seeing them go. The government right now is investing in just about everything, but it's a little bit more bias on the lower coupon notes, which means they're trying to grab some of that lower stuff because they want to get some loans into that in the future, build up that yield, because they're projecting down the road it's going to be higher. And so there'll be a spread. Okay, so a little bit more bias on these lower ones right now. And that's just the current trend. Same thing why we see, every once in a while we'll promote from a risk standpoint, well, we might promote like 15-year loans or 10-year loans. And because we get those down into these really low coupons, so we're doing 10 and 15s at like 2.25. Maybe you have to buy those down a little bit, but I mean, low rates, and they're fixed. And the idea behind it is over that next 10 years or 15 years, like guaranteeing just that amount versus what the market may spread or adjust to there'll be some profitability in there for these banks. So there's a good appetite for those. Plus, if you're doing a 10 or 15-year loan for somebody, same debt ratios apply as they would on a 30-year. So they're sending a lot more money to that loan, trying to pay it off faster. Generally, it's a stronger buyer or homeowner anyways, so low risk.
Yep.
But yeah, that's kind of the appetite right now from a refinance standpoint. 30s with at a certain note rate seem to trade really well. So it's interesting. You can see sometimes on my rates, I'll look at like a 3.25 rate might be more expensive than a 3% rate. It just has to do with what coupon that might be trading on. So we look at the whole rate stack a lot of times, and we've seen it where 3.25 may have a small cost, but like 2.875 is giving them a small credit, or 2.75 gives a credit. It's just a really weird dynamic the way that works. So you can't just. It's not like a one size fits all. You have to look at each scenario and see where it fits.
For sure, it's making it interesting, right?
Yep, it's fun. I mean, it's fun telling somebody like, yeah, you closed you last year. We're going to save you $300 on your mortgage. That's fun.
Yeah. Especially in today's environment, people are all about saving money, right? Getting their overhead down because who knows? Yeah.
A little bit of relief in the cash out markets too. So for a little while, like banks were like, cash out, no, we're good. If the FICO score is, good enough and borrowers strong enough, the cash out refinances actually price out pretty decent right now. So a little bit of relief in that market, probably since the last couple of weeks that we talked. That's encouraging. And we have, so on my side, I've seen at least an uptick on people that they're cashing out and they're holding on to money. And I always ask them, like, what are you going to do with that money? Are you going to put a new kitchen in? Are you changing out your roof? What are you doing? Like, just hold on to money. Like, well, I mean, you got to do something with it, right? To pull it out. And they're like, I don't know. Like maybe I'll buy an investment property. Maybe I'll buy some stocks. Like they just want to be ready because they know an opportunity will be here someday. Yeah. And they missed it. When S&P dropped 30%, they didn't have money to invest in it. So they're stacking it up and they're just kind of waiting. And, because the money is so cheap to borrow, by pulling 100 grand out of the house, that the amount of cost costs them to keep that money in the bank. It's worth it for them to have that cash in hand ready to go if they want to, do an opportunity. So we've seen an uptick, at least in the last couple of weeks on those.
For sure. I mean, if you pull the cash and it's at 3% or 4%, right? And
even at 4, it's great.
Yeah, you put it in the market and you get 8.
Right. Yeah.
Okay.
Yeah. Yeah.
And that was free money to you because you pulled it out, right? Anyway.
Exactly. And so on cash out, and that's another question that comes up. So people do a cash out refi and they're like, well, all right, so let's say I take 100K. What's that going to look like on my taxes? And we're like, nothing. What do you mean? Like, I took a loan on my 401k once and I had to pay all this money in taxes. I don't want to do that again. Like, it doesn't work that way. You're pulling debt. Because you're pulling debt, it's not going to show up as a 1099 or something on your tax return.
Yeah.
You're not paying taxes on the money. So you're parking it. So yeah, you're paying interest on it because you're taking a loan. Because it's secured against debt, you're not paying a cost on that today, at least in an income tax standpoint. Park it, can do something. So for some people, that's been a good play. That's probably your more savvy, investment minded kind of folks, realizing money's cheap, opportunities around the corner. I want to be ready. And yeah, so we're seeing a lot of that.
For sure. That's awesome. I'm glad that they're loosening up on that.
Yeah.
Anything else going on interesting in the last week or so?
No, not really. I mean, just busy. I think for a lot of people, July, from a lot of lenders across various companies and states even that I network with, are seeing that July is going to be the busiest month that they've either ever had or one of the busiest.
Yeah.
So I think moving forward for home buyers and home sellers, be prepared for slightly extended times. Okay. Yeah. So the day of like, oh, let's slam it through in 15 days. You might be able to do that sometimes, but more often than not, you're going to run into a situation where you might need 40 days instead of 30 or something like that. So I think setting expectations for people, as you start to do, because a lot of homeowners that are maybe going to sell their house, they start to plan it out. Well, if I do this and I do that, we'll be in before school starts. Got to use a little bit of an extended, even though the house may sell fast or go on the market and go into escrow fast, it may take a little extra time to close if this continues. And it's projected that we'll see these high volumes for a while. Our industries, the whole mortgage industry, has the capacity of around maybe 1.5, maybe $2 trillion worth of origination in 1 year. And $2 trillion, like you're putting all the processors, all the underwriters, all the closers, everybody involved is standing on their head and ready just to completely give up and throw in the towel to try to knock out $2 trillion in an industry like that.
Yeah.
So, and we have an opportunity right now with where rates are, it's like 5 or 6 trillion. So you're trying to shove all of this money, all this opportunity into these really, really small months or small windows. That's a really dangerous place to go, especially when you're talking about having refinances mixed with purchases.
Yeah.
You have to have separation. So we did at the corporate levels, we split channels. So it's almost like we have 2 banks. We have a refinance bank and a purchase bank. And the reason for that is the only people that do purchase are touching purchase. And the only people that, they're assigned to do refi, they don't touch purchase. They just do refi. It has to be that way. Otherwise, if you mix those waters, you got somebody that's looking to save $100 on their loan and they're in front of, families that are trying to move and relocate. That's a mess. So watch some of that moving forward.
Awesome. All righty, sir. Well, thank you and enjoy your weekend. And I will chat with you again soon.
All right. Thanks, guys.
All right, take care.